All right, back to school. Here we are. What's happening, guys?
A whole bunch on this end, Jay. What about you, Craig?
Yeah, kids are back in school. Summer's always a good break for kids and families, but I think a lot of parents are happy that we're back into our regular routine. Sports are up and running, and yeah, life is busy.
Hopefully everyone's feeling nice and refreshed and ready to conclude a very good year in the market so far on a good note.
Really surprising if you consider how we started the year with all the headlines, negative markets. You're right, Jay. It's been a tremendous year so far.
Yeah, so let's get into it. Embarking on episode 24 of Wealth Talk. Mark Carney, 100 days in office. We've got some kind of data points to work with now. 2 straight quarters of GDP decline, 7.5% drop in exports, 66,000 job losses. Unemployment continues to tick higher, above 7%, in stark contrast to the US unemployment levels, which are materially lower. We've got tariffs on steel and aluminum. Elbows are up, I guess, on the policy side of things. Markets do not agree with that economic data that I just laid out. We've got Canadian markets trading at all-time highs, up close to 20% year to date. We've got the Canadian dollar appreciating against the US dollar since Carney was elected. Kind of conflicting stories. So where are we at? What is the economy telling us? Why is the economy kind of expressing a little bit of a different story than what the market's telling us? Does Carney have a lot to do with that? What are your thoughts?
So when we give them a report card, do we give them A, Bs, and Cs, or proficient, extending, and developing like we do our kids now in BC?
Well, I would say that he's been front and center over the last week or so with these new announcements, and there's a common theme that I take from this, and markets obviously disagreeing, but I would say that Carney's report card on Canada is that we're still in a crisis. That's the word that I hear very often, is we're in a crisis, we've been in a crisis, we're going through a crisis, how we're going to manage this crisis. So how's his report card on Canada? It seems to me like we're failing here in Canada, and we've talked about that many times on this podcast, how challenged we are on productivity and inflationary pressures post-COVID. But yeah, I don't know. Does it feel like we're in a crisis? Clark, what do you think?
I'm going to disagree with you a little bit. I mean, if we give the Canadian economy a report card, I would say that we're, not in the A's and the B's, but let's look at Carney, and if we want to grade him, a lot of what we're seeing out there in the economy, is a result of 2 things. It's a result of his predecessor, the former Liberal government, and it's also a result of action taken by the Trump administration in the U.S. as it relates to trade and tariffs. So I think, if we were to judge Carney, I think we'd have to judge Carney on what his plan is, or how he's dealing with this crisis and the action that he's taken to take advantage of an opportunity that Canada may have. As we talked about on these podcasts previously, you can look at these tariffs, and trade issues as 2 different things. You can look at them as a crisis, or you can look at them as an opportunity. And I think so far, going back to grading Carney, I give him probably a B or a B plus. I don't think he's been aggressive enough on trade. That's where I think I'd knock him some marks. But if really what Carney stands for, and he is, a lot of his policies or his values are one thing, but what I give him credit for is actually, not making policy that represents his own values, but what he thinks is going to be in the long-term best interest of Canada.
Yeah, and I think along those lines, he dropped the carbon tax, might be emerging in a different kind of format, but he did that, and I think that was helpful, obviously, in terms of just lowering the overall tax burden we have here in Canada. He dropped recently the EV mandate, which I think will be helpful for avoiding kind of costly transition that we just really can't afford right now. This whole one Canadian economy policy of reducing, tax and regulation between provinces, I think is good. I mean, a lot of the specific policy mandates he's come out with so far are, to your point, Clark, a reversal of the previous administration's policies that were helping to or not helping to promote growth, but hindering growth. And I think seeing some of those kind of backtracked has been helpful, and in part maybe why some of the market has appreciated his early days in office. So I think that's a welcome sign that maybe there's more pro growth Canadian policies in store for us.
Well, I believe they just came out of the Liberal caucus out in Edmonton last week, where they announced, the further support of a lot of these projects that are already, far into their process. Where I do give him a B plus or even an A is you've certainly seen a change in, as I think you mentioned it, Jay, the provincial borders that were more or less in place. You're starting to see the agreement amongst a lot of these premiers. And even when you get a bit of a backing by Alberta and Saskatchewan, Manitoba, who've certainly felt alienated under the previous Liberal government, they're starting to, I dare say, rally behind Carney, but they're talking a lot more positive about what's been announced recently and, the plans going forward by the Carney administration. So, that I give an A plus is bringing Canada together. It seems like we're getting closer and more aligned on the provincial front.
I think when you look at the markets, you kind of have to look at, I mean, we always talk about the markets being a forward indicator, and the markets being as positive as they have been, I think is a good sign. It potentially portends more growth ahead of us for Canada. However, I'll caveat that slightly, recognizing that the biggest gains we've seen so far in Canadian market have been in gold and silver, which are often components of the market. When you see gold and silver rising in price, it's somewhat indicative or often indicative of currency debasement, which is obviously another concern that we've tried to shed some light on in previous episodes, in terms of what does the Canadian budget look like and what does the Canadian spending plan look like over the coming years. Obviously, there's been massive deficit spending over the previous 5 years, and the big question mark is, will that continue to be the case? Is inflation likely to rear its ugly head again if the Canadian government cannot kind of control itself on the spending side of things? So, gold and silver have really done well, and potentially they're suggesting that there's more, reckless spending ahead for the Canadian government, but hopefully we see some more constraint and a more balanced budget, although that's a big question mark. What do we expect when we get, I think we get a little bit of a budget update before an official budget gets released, hopefully early next year. But what are we expecting on the spending side of things? Can Carney kind of constrain spending a little bit so that we can see a little bit more balance, or what do we expect on that front?
Well, first, I think you are correct with the Canadian index. It's been significantly affected by the strong performance of gold and other precious metals this year. Now, keep in mind, though, that has nothing really to do with Canada. That's really all external factors, like you talked about currency debasement, U.S. debt, things like that.
Safety.
Yeah, flight to safety per se, or I wouldn't say safety, but perceived store of value. The other thing that's going on with Canadian markets is the same thing that's going on with international or non-North American markets. Is European markets have seen significant strength this year, and they haven't necessarily seen corresponding significant economic weakness that would account for that. And I think a large part of that is kind of a sell USA trade and buy ex USA, and it's not necessarily a sell USA, but there's been a big global shift of capital away from US markets to look for opportunities elsewhere, and I think that's benefited or most international markets, including Canada.
I agree with that. There's certainly been an attractiveness outside of the US, but US markets are also at all-time highs. And for the better part of the first 6 months of this year, heading into 2025, everybody was fearful of um, the Mag 7, the large big cap 7 in the US, and the concentration that they represented on the indexes. But what you've seen now over the last quarter or two, you're starting to see that broaden out. So not only people are just buying the big cap 7, which most of those are at an all-time high yet again, but they're buying financials, they're buying industrials, they're buying consumer discretionary. So the overall breadth of the market is actually starting to expand, and it continues to expand. So yeah, there's money, I dare say, exiting the US. I think money is flowing in all markets right now.
I agree with that, Craig, but I think if you look at the relative performance between US markets and non-US markets this year, it's the first year in many that the US has underperformed basically the MSCI World Index, I would think, or other countries within that index, like Europe, like Canada. So I think that is a result of, I corrected myself earlier when I said a sell USA trade, but I think there is a shift of capital on a relative basis from US markets to international markets. Various reasons for that, but I think that is a good part of what we're seeing.
I think a big part of it's a reflection of just a demand for quote unquote risk assets. As interest rates come down, we're going to get those announcements over the next couple of days here in Canada and the US. And as interest rates go down, asset prices appreciate. And, we talk about the gold sector and precious metals here in Canada. Let's not forget about the strength of Canadian financials. A lot of the names that we own in portfolios, such as the BMOs, TDs, Royal Banks, they're at new all-time highs. And I think that's a reflection of interest rates coming down and the attractiveness of the dividend that they offer as bond yields, GIC rates decline. 2 years ago, they were at par, if not GICs were in excess of Canadian dividends. So I think you have a combination. I agree with you, Clive. There's money going out of all parts of the global markets, but I think there's so many other contributing factors to why risk assets are doing well this year.
So Carney, through his first 100 days, we'll give him somewhere around a B, maybe. I think collectively is what I'd kind of draw the three of our opinions towards. And what do we look for going forward? Like, what's going to really help kind of turn the tide when it comes to GDP growth, when it comes to unemployment rates? What can we kind of hope for from Carney going forward?
I would say that my hope is, a lot of the announcements over the last couple of weeks, and I think even this morning they came out with another housing initiative that, at this point, a lot of it may be just politicking. I'm supportive of it and I'm hopeful for it, but we need to continue to remove the red tape and the regulation that holds up a lot of these projects. We can talk about continuing to build out LNG plants and small nuclear reactors, but if that time frame to get those from start to finish is measured in, years, if not potentially decades, I think a lot of it may just be politicking at this point, and so removing red tape, getting more alignments amongst Indigenous groups, municipal, provincial, federal government, to fast tracking some of these projects so we actually can export more of our resources and build within our own borders. So you see that would be my biggest constraint right now.
I think those announcements are significant. I think if we look over the last decade, there is a huge reluctance in Canada to build infrastructure to transport our natural resources. And generally, they can be done in a relatively clean way. I think it was Trudeau who, a number of years ago, said that there was not a market in Europe for our natural gas. And that's such a naive view. And
He said there's no business case for LNG, which is completely insane in hindsight, but
yeah, and we've got an abundance of natural gas in this country and in this continent, and an abundance of demand in places where it doesn't exist, or doesn't exist in a large degree, like Europe, like Asia. And these are the kind of opportunities that we should be taking advantage of. So if you look at these key projects that he announced, they're very heavily weighted towards LNG. And I think that's the right thing to do. And infrastructure build in Canada, creates jobs, it stimulates the economy, and it has a long-term effect in finding markets and finding markets for our natural resources.
Certainly, it seems like there's a shift back towards resource development and responsible resource development, which is obviously Canada's has been part of Canada's strength and will continue to be, whether we like it or not. We're a resource economy, and developing those resources is going to be critical in terms of growing the employment market and growing the economy. So I think that's been a very welcome change in this administration. Any final thoughts on Carney and the Canadian economy before we kind of shift gears a little bit?
We had a few comments about housing. We'll see what happens again with Bank of Canada coming up. I think at best the Canadian housing market, in particular in key areas like Vancouver, Toronto, and I even say here in the Okanagan, we're muddling through. It's it's a balanced market at best, if not it's probably a buyer's market. Lots of supply continues to come on, so we'll see if you continue to see a trend lower for mortgage rates, which I know a lot of 3 and 5 year variables now are under 4%. So money is getting more attractive. That's a huge component of the Canadian economy and GDP. So I'm cautiously optimistic to see what happens in the Canadian housing market, in particular with this announcement today with the Liberal government over the next few quarters, and maybe you can see resuscitation there.
I mean, such an important piece of the economy. We've, created this focus on housing for so long now, and so many jobs are dependent on the development side of things. And that's just been such a continued weak spot, as anyone that's living in Vancouver has been fairly aware of. I think Toronto, it's even worse, that the Canadian condo market, or the condo market in Vancouver and Toronto, has been really struggling with kind of every week a new developer either selling portion of their interest in projects, like we just saw recently with Westbank and the Seneca project down at the Burrard Street Bridge, or other developers declaring bankruptcy or going through insolvency. So it's been such a weak spot, and you have to wonder how much that's going to play into the whole unemployment story here in Canada, with so much employment being dependent on construction. So with interest rates potentially going lower this week, hopefully that unthaws things a little bit. But the other side of the equation is the immigration policy that's seen a pretty significant shift here in the last 6 months. So where do we go from here? What's in store kind of for the next few years when it comes to housing prices? How should our clients be thinking about real estate as an investment option?
I think the problems that we've seen with developers are really just the tip of the iceberg. I think there's a lot more yet to come. I think that's one side of it. And if these developers are having issues or financial issues with these developments, they're going to be less willing, and reluctant to develop additional projects. So I think that's going to be an issue that works against supply. And then you've got the demand side, and which could be a positive for bringing prices down. You don't, with immigration policy, you don't have 1 million or 1.5 million immigrants coming in per year looking for housing. And then flip it back to the supply side. You look at some of the restrictions that were put in place, whether it's speculation tax, whether it's taking all these rental properties out of an ability to rent them under VRBO or Airbnb. You still have a lot of those condos listed for sale as a result.
The biggest thing would be nice to see affordability come back to the Canadian marketplace. I mean, it's been such a kind of type of tax on the Canadian consumer, where such a large portion of everyone's paycheck is going into shelter, whether that's high rents or high mortgage payments. So much more investment could be created if all of a sudden we had an economy or a market where housing costs weren't such a big portion of everyone's paychecks. So I think, in my very optimistic view, if we can get through this kind of downturn in housing without too much damage to the, consumer and to development firms, and we can kind of get to a place where you've got more affordable housing, you've got cheaper rents, you've got more rental supply. I think as a whole, in terms of creating a more balanced economy, in terms of actually attracting more people that we want in our country, whether it's doctors and engineers or all these kind of pieces of the immigration puzzle that every country is trying to attract. If we can get our affordability levels back into a level that is realistic, I think that's overall a net positive for the Canadian economy going forward. Whether or not we can do that, I mean, it's a fine needle to thread where you've got on one hand the employment side of things, but on the other hand, hopefully a more balanced outcome when it comes to pricing. So we'll see.
To just mention, what's happening with interest rates here. Do we feel that the Bank of Canada, the US Federal Reserve, do you think they're behind the curve here with cutting interest rates? There's that wide expectation that we see a 25 basis point cut this week out of the US. Even some people are talking a 50 basis point cut in Canada here. I don't know where the exact odds are for a cut in 25 basis points, but are we behind the curve? Are we too late to the game here to resuscitate the Canadian economy? And the other thing is a lot of news recently is challenging the independence of the Fed and central banks. Where do we stand there, Clark? What do you think?
Well, first of all, on interest rates, whether they're behind the curve or not, I think the current level of short-term interest rates in the States, I'd argue that they have been a little bit behind the curve, but that's from the perspective of being behind the curve a little bit as it relates to potentially stimulating the economy. The other side of things, though, for the Fed, the other side of their mandate is fighting inflation. And that is generally a tougher thing to fight. And they had a lot of uncertainty coming into this year with a ton of uncertainty over the Trump administration's policies on tariffs and trades. I would argue they still have a ton of uncertainty over that. And that could result in increased inflation. We have seen inflation tick up. So they may be a little bit behind the curve from the perspective, again, from what we look for, which is stimulating the economy, but they're not in managing their other mandate as well.
They also have to look, I mean, the market's at all-time highs. It's kind of an interesting time to be cutting interest rates, right? I mean, there's the housing market is obviously the other big kind of component that is dependent on interest rates, but it's not often you see interest rates being cut when markets are at all-time highs and inflation is still running, a tick higher than the kind of 2% mandate, at least in the US.
The inflationary data we received last week, you didn't see a pickup in it. In fact, it came in line with expectations. So, if we remind our viewers what the dual mandate of the Federal Reserve is, it's maximizing unemployment, number one, and two is price stability. Unemployment rates, I think, is what they're looking at now. The unemployment rate in the U.S., as it has in Canada, continues to tick up. With inflationary pressures, I agree with you, Clark. We've maybe yet to see that, but so far it has not materialized. And I think that's what's giving the central bank's breathing room here to cut, is the fact that under the surface, the labor market is softening.
I would agree, Craig, but I'd also say that part of the reason why it hasn't materialized is the Fed's desire to keep interest rates where they were, as opposed to cutting them drastically, like they've been suggested they should do. Just think if interest rates were cut by a point earlier this year in total, what would that have done to inflation? What would that have done to asset prices? So I don't know. I'd be on the other side of that argument, I think.
Well, yeah, well, exactly. Do we want the housing market to start here, at least here in Canada, to start pricing higher again? I mean, again, kind of my preference would be for housing prices to continue to trend lower to get to a more balanced side of things. I think if you cut interest rates aggressively from here, I think it's great, first of all, that we're not where we were 2 years ago, where mortgage rates were 6%, and a lot of the mortgages that are coming due up for renewal this year are renewing from a 1% mortgage rate. Going to a 6% mortgage rate could have been catastrophic. So being back in the 3.5% to 4% range is probably a level that the Canadian economy can do okay with. So it's a tricky one, right? We all want interest rates to be lower to see the economy do better, but that kind of 1980s chart of inflation where you had this one wave and then it rolled over, and then all of a sudden inflation came back even more significantly than the first wave, and interest rates ultimately ended up at 18%. I mean, no one wants to see that happen again. So I think there's always going to be some reluctance to lower interest rates with inflation still not completely under control. It's not where we were a couple of years ago, but like I said, it is still slightly higher than that 2% kind of target that the Fed looks at.
A couple of minutes ago, you mentioned the independence of the Fed. Why don't we go down that rabbit hole a little bit? Because this is all related. The dual mandates stimulate the economy, stimulate asset prices, but at the potential expense of inflation. Do you want to address that a little bit?
Well, at the end of the day, it's been pretty clear that the Trump administration has put in pressure on Jerome Powell and the Federal Reserve to cut rates. But I don't think that's, I'm going to say he's aggressively approaching that or addressing that, which is not much different than you say, Jay, with most politicians. And, everybody wants lower interest rates because it looks good under their administration. I support the Fed's independence and the fact that Jerome Powell has been reluctant to cut rates. I think he's done a pretty good job over the last couple of years here on maintaining that independence. Whether he cuts rates or not this week, 25 or 50 basis points, I don't think that's a reflection of the pressure. I think he's a clear data-driven leader, and I think that's what they're basing decisions off of. So what can we challenge about the Fed independence? Do you think they're receiving pressure, or?
Well, I think, there's always going to be moral suasion by politicians as a form of challenging the independence of the Fed. Trump wants lower interest rates, so he and his administration are going to suggest that's what the Federal Reserve should be doing. I think what you may have been hinting at a little bit was what's been in the news recently, where there is mandated independence of the Fed, meaning, Fed governors, the chairman of the Federal Reserve is an independent body from the government. And those governors cannot be fired for political. Well, they can't be fired, say, by the president, particularly for political reasons. And I think that's where that independence is coming under pressure with Trump. He did fire somebody recently. I fired one of the governors.
Yeah.
And he suggested, and kind of testing the waters a little bit, of firing the chairman, Jerome Powell. And I think that's a dangerous road to go down. There's a reason why, when the Fed was established years ago, that it was established as an independent authority.
I mean, Trump looks for every opportunity to defy, norms and precedents. And I think what did he fired the leader of the Department of Labor Statistics because they didn't like the jobs number that they put out a couple weeks ago. I mean, it's incredibly difficult to maintain your independence under Trump's administration with the expectation that you're going to keep your job. I mean, if you put out a number that he doesn't like, you're going to hear about it. So I think it's important that the Fed remains independent. Obviously, you don't want every politician tweaking monetary policy to suit their agenda. I mean, that's just not the way the Fed was designed to operate. And there's a case to be made for interest rates to be lower, and certainly it would help the U.S. in their mounting debt and deficit spending. But in the wrong environment, that's a very dangerous game to play, where all of a sudden you've got the president making monetary policy decisions at the expense of what their true mandate is, which is to control inflation. I mean, if inflation starts running hot again, and all of a sudden you've got Trump with his finger on the scale, to suit his best interests, that's a bad scenario to unfold.
As long as the Fed remains true to their dual mandate, I think we have no problem with that. I think, on your point with Trump firing the head of the Bureau of Labor Statistics. Now, I don't necessarily agree with Trump there, but what I can agree with is the data that we continuously see out of the BLS, which, if you look at it every single month, that data is revised. And they're revised by a significant amount, whether it was employment numbers, labor force participation rates. And I find that hard to believe that in this era, when we have access to real-time data with AI, et cetera, how every single data point that the labor statistics comes out with is revised by a pretty wide margin. And that reflects back on the Fed's dual mandate, maximizing unemployment. They rely on that data to drive their policy. But if that data is continuously a moving target, I get it. We need to have better reporting. So I think the Fed can probably make better educated assessments. And I'm not challenging the way they do things, but I think we can improve upon the ways in which they arrive at those answers.
I'd agree with that. Yeah, something as simple as real-time feeds by the payroll processors like ADP.
I don't know if they're
give
using
them
Excel
real-time
spreadsheets
information.
to get that data, but it just seems like because the data is released every Friday of each month. And I guarantee you, when we get October's data, September's numbers are going to be revised by a large number. I think we got to improve on the way that those statistics are reported.
It's 350 million people that live in the US, however many people are working, 200 million people are working. And I mean, there's going to be some challenges in aggregating who's working and who's not, who's been fired, who's been hired. There's it'd be nice if it all appeared perfectly in real time, but easier said than done, particularly when you look at some of the employment scenarios in terms of the farming industry and stuff like that. So they're not necessarily operating on a spreadsheet. I think that's a pretty good little back to work, back to school coverage of kind of what's been happening up here in Canada. We've got Carney giving him passing grades, I think, across the three of us so far. We'll hope that continues to promote growing Canadian economy, improving employment numbers. We'll see what happens in the Canadian housing market. I think that's definitely something that is worth watching, and obviously pretty critical to the Canadian economy. And there's definitely going to be some interesting developments on the Fed side of things, and interest rate policy will be something we're closely watching both here in Canada and the US. So let's hope the trends we've seen in place, at least with regards to the markets through the first 9 months of the year, remain so. And we'll pick it up next month with our regular programming. So thanks everyone for joining us today. Hope you enjoyed the conversation, and we'll look forward to any feedback that you might have. Thanks, guys.